Eliza, please, the screen is yours.
Okay, thank you, Mikkel. This is some joint work with Jonathan Brogard from University of Utah, Hung Nguyen from Da Nang University in Vietnam, and Talis Putnams and myself are both from Sydney. So it's great to be joining you from down under, and thank you everyone for jumping online and tuning into this talk. So I thought this lady in the picture here really captured what we wanted to do in this study very well. So you can see that, you know, she's showing a lot of anguish. She's trying to block out the noise to figure out, you know, what's going on. And I hope the title that we have captures that sentiment as well to some extent. So we're trying to understand what's driving all the stock price movements, and we were sufficiently motivated with the developments in the R-squared from the market model that we all know and love. Earlier on in the literature, with the work of Campbell and Mork and Wergler, it was well documented that the R-squared from the market model had been showing this declining trend up until the mid-90s. And the conventional interpretation from the R-squared is that, well, if we have lower R-squareds, then that's good. It's showing that there's more firm-specific information that's being reflected in stock prices. So there's more information content. The firms are now less synchronous with overall market movements. But what we've since learned is that, well, the R-squared has actually changed its trend. It's now showing an upward trend since the mid-90s. And so what this is suggesting is that, well, you know, based on our conventional interpretation of R-squared, what we have now suggests that the market is less efficient in, you know, where we are now compared to what it was back in the 1960s, which doesn't sound quite right. Or alternatively, it might suggest that the R-squared just isn't a good measure of informativeness in asset prices. So we're not sure which one it is. Either way, if it's the conventional interpretation with increasing R-squareds, we have less stock-specific information being reflected in prices, then that is of concern, because following that earlier literature, we know that capital allocation is going to be less efficient, and we need more stocks in order to get the same diversification benefits. So it's not good to be having less information content in stock prices. But if instead it turns out that, in fact, the prices are simply becoming less noisy and there's more liquidity, well, that's actually still a good thing. So in order to be able to figure out what's going on with all the noise, as you saw in the picture earlier with the lady, we need to be able to distinguish between information and noise in asset prices. And so what we contribute in this study is we are expanding the empirical toolkit with a new variance decomposition that allows us to do just that, to separate noise and information within stock prices. And then we want to understand the various sources of information within asset prices as well. So how do we do that? Basically, we are linking three different literature strands. So from the existing market microstructure toolkit, the study of price discovery is very well resourced with all the technology to be able to understand the temporary price variations and the permanent effects that information has on asset prices. So as new information comes, it gets impounded into asset prices. And we also understand that based on trading activity, there's also a lot of private information that can be revealed, as well as what's reflected in the prices themselves. And with the Mork literature, based on the R-squared, we also know that, well, there are different types of information. The market model suggests that there's market-wide information, And if it turns out there isn't as much market-wide information being reflected in stock prices, then it suggests there's more firm-specific information being reflected. But this framework really says nothing about the role of noise. Similarly, there's the work by John Campbell, which shows there are two key sources of information coming from innovations in cash flows, or the cash flow news, and the discount rate news as well. Okay? And again, within that framework, there's nothing said about noise. So what we do with this new method is we are basically using the essence of all these different methods. We are assuming that there's both noise and information within asset prices, but we specifically are trying to decompose the stock prices to understand the different types of information that is contained alongside noise. Okay, so our attempt to do this can be summarized in this schema. So basically within overall stock prices, we are saying there's the noise component, which you see down the bottom here, and then there's also underlying information. And that information gets impounded into the stock prices. And we know that there's the market information within that and firm-specific information. But going further beyond that, we also know that even the firm-specific information can be revealed through just the prices, publicly through the prices, I should say, and privately through the actual trading activity that we can observe. All right, so moving along, if we start with basic understanding that log prices are basically efficient prices M plus some error term, and that these underlying efficient prices M follow a random walk, let's say with a drift, then we know it's the past efficient prices which are going to determine the future, plus there's a drift term there, and all the information gets impounded as it arrives. As new information comes, it gets impounded into these efficient prices. And that's fundamental based information that will be reflected. Okay, so then if we think about returns being the change in the prices, then if we do some arithmetic, we can see that within the returns, the stock returns, we have the drift term, we have all the information components, and then we have the noise coming in, which is the change in the error terms. So, okay, so let me move along quickly. Now, in terms of implementing that idea, what we did was we first used a structural VAR with three equations, being the market returns and the trading activity and the stock specific return. And we used 5 lags for each of those to explain in each of the equations. And then we invert that VAR into this structural vector moving average that you see. And we use impulse response functions in order to work out what the permanent impact of these different components are. So here we see with the infinite errors, the effect of all those over time can be really captured with an impulse response function, and that's the contribution with the market information coming from there, and that's the contribution coming from trading activity, which is the private information being impounded, and then this is the stock's own public information. Okay, so if we then think about all the permanent components, all the information in this context, the thetas here really come from these impulse response functions, and we can show that they all contribute different sources of information towards that information component. And then the noise is simply the realized return minus the drift, and then all these specific information components. Okay, so moving along, I just wanted to say that, well, it follows then that the variance of information-driven innovations in the efficient price is made up of all these different components variance. And so we can think about it in terms of the contribution of each type of these information towards total variance in this way. So in order to compute all of these and to analyze it, to understand what's driving stock return movements here, we can, what we did was we used all the US stocks from NASDAQ, Amex, and NYSE over the time period from 1960 basically to the 2015 period when we first collected all the data and started the analysis. Okay, and this is what we got out with our decomposition. So you can see with the grey line here that indeed there's a lot of noise, and it's very noisy noise. Okay, so the big change here is the increase in noise in the lead up to the mid-90s, and then the big decline, this whole peak here. And surprisingly, there's about a third of overall movements in stock prices, which is actually due to noise and not any kind of information. Market information, as you can see down the bottom here, really only contributes less than 10% to overall stock price movements. Now, the combined, the red one is the public information, the green one is the private information. What's interesting here is that they actually start off providing equal shares. So they're equally important in moving stock variance. But over time, what we've seen is that the public component has increased, as has the private, but not to the same extent as the public information being priced in. And we argue that a lot of that has been due to improved disclosure that's come about. So now there's more public information being reflected in the actual prices. Now, I'm going to talk about each of these in a bit more detail. So what we notice from the market component is that it rises with crises. So during the energy crisis that we had in the 70s, 80s, and then the stock market crash, the dot-com boom, the last GFC, as well as now COVID, what we see is that the market share that we have, the market information share that we have, seems to reflect these peaks with the crises. So we're trying to show that this is what we've extracted is indeed reflecting the market information, which you can see naturally peaks in times of crises. Noise has declined, well, initially increased in this period where there was a lot of collusion by dealers to avoid odd eights, so that artificially increased the spreads. And then subsequently, as the tick size was reduced from 8ths to 16ths, we also noticed that the noise component reduced. So in terms of overall information, now these components are currently shown for trading activity or private information coming from signed dollar volume. When we use another proxy, which is order flow, we get a slightly different composition, but overall the two components remain very similar. So what we're saying here is that most of the movements in prices is due to firm-specific information, right? Whether it's from the public source or whether it's from the private source, most of the movements is driven by these two firm-specific components. And so it suggests that the market prices overall are not becoming less informative, because we can see there's this upward trend in the importance of these information components. Now, in the interest of time, I'm going to skip across the cross-sectional variations that we have, but overall, what we wanted to show there is that a lot of the variations are due to the size of the stocks. In particular, as you'd expect, you'd find the smaller stocks are the ones that are much noisier, and the ones that have benefited from the improved disclosure and hence had the reduction in noise. Okay, now what we do here is we are trying to validate these components that we've pulled out. So we've used some natural experiments here. In particular, we are trying to explain the noise information share. And we show that when we had the tick reductions from the 8s to 16s, so that was a good thing. We find indeed it was particularly for the smaller stocks with the relative, the larger relative tick sizes, where we saw the biggest benefit with the reduction in noise coming in here. Okay, so all the negative coefficients highlighted. And then another, and this was also the case when we used the continuous log price level instead of the size quartiles. And another natural experiment we used was the experience with the collusion that was shown in Christie and Schutz. And then what we showed is that the NASDAQ stocks that were affected, where the collusion was documented to be, in fact had a noisier prices during that period of collusion. Okay, so that validates our noise component. What we also did was we looked at these exogenous changes in analyst coverage with the well-known experiment with when these brokerage houses merge and close. We find when there's a reduction in analysts following the stocks, there is this decline that you see here in the public information being reflected by 1.59%, and the noise component increases by 0.59%. So again, this validates what we've actually pulled out of the stock returns here. Okay, there's not much impact on the market information and private information share, because we expect with the analysts and their activity, most of their earnings forecasts and guidance is publicly known. So hence it's the effect on public information that we see here, and the reduction and the increase in noise when we lose the analysts, when they disappear. Other validation test was to map what we have to other price efficiency or information efficiency measures, and again we find our components seem to behave as you would expect if they were to be respective information components and noise. Okay, the last thing we did was we provided a further granular decomposition by firstly pulling out noise from expected returns, and then conducting the Campbell-Schiller decomposition. And what we found in doing that, in initially removing the noise component from returns, was we found after you've done that, the cash flow component or cash flow information now becomes much more important, as you can see with this blue upward trend showing here. Whereas the discount rate information actually remains very stable once you've pulled out a large chunk of the noise from what we used to attribute to discount rate news. Okay, and I guess the other point to make is that the noise component has gone down as the cash flow importance has increased. Okay, so in summary, by doing that, what we found was we were able to reconcile with a lot of the existing results out there on various decompositions. Because when researchers conducted these decompositions on portfolios, they found it was discount rate news that dominated. But when they went to look at the stock level, it was in fact stock cash flow news. And what we're showing here is now at the firm level, when you take out the noise component as well, in fact, the cash flow news becomes even more important. Right? It is the more idiosyncratic component out of the stock returns. So overall, in conclusion, what we contribute is this new empirical framework. So it's a methodological contribution that we're trying to make. And it's a methodology that can be generalized enough to look at international stocks. We've applied it to US stocks here. but it allows us to look at different sources of information. We've demonstrated that with the cash flow and discount rate news and the various information sources that we've looked at here. Okay, so overall what we find is that since the mid-90s, there has been this dramatic decline in noise, and over the same time period, firm-specific information, whether it's from the public source or from the private source, has increased, and this is more consistent with an interpretation that the market has in fact become more efficient, rather than what the R-squared is suggesting, the increasing R-squares are suggesting. So we think this suggests the R-squared is not a sufficient measure of market efficiency or informativeness, if we think of the flip side of it. Okay, so that's where I might leave it. I'm very keen to hear Petri's comments on this work. Thank you.
Okay, thank you very much, Eliza. So Petri, you have 15 minutes.
Okay, can you hear me now?
Yes, we can.
And see my screen, great. So first of all, thanks so much for Michal to organizing this conference. Again, though last year there was a bit of discussion that it would have been just one-off. I think I was one of the more voiceful defendants of this conference, and happy to see it happening again. Also happy to see it running so smoothly online. So let me jump into the paper. Overall, I really enjoyed reading this paper. In a small nutshell, the paper, as Eliza brilliantly just told us, does the variance return decomposition for individual stocks on an annual basis, breaking down return variance into market information, and then two types of firm-specific information. There's public and private firm-specific info, and then there's just noise. The model is intuitive. The estimations seem straightforward. I like the validation tests a lot. They were smart and convincing. Also, the paper is well written. It's clear. It's easy to follow. It's simply brilliant. I love it. Super annoying to discuss because I have nothing to say. So now I have 13 minutes and 45 seconds to fill. I'm going to talk a bit about future avenues. The paper sort of already refers to what you could do with this measure, but maybe not that much for the authors, but for the audience and myself, I laid down some things where you might want to use this new return decomposition. And then I'm going to nag about some really tiny details of the paper. Okay, so first of all, you could use this for anomalies. So you could look at are different anomalies associated with different types of variance composition? Are value stocks loading or is value stock variance very different from, let's say, growth stocks or small stocks or large stocks or momentum stocks? Is there any difference, systematic differences in anomaly portfolios? What happens to variance composition once the stock becomes an anomaly trade? For example, what is the composition of a moment? So think of a stock that is in a momentum winner portfolio at one point in time. What is the composition of variance before it becomes a momentum winner, during when it becomes a momentum winner, and after that? Especially during the 12-month return measurement window before forming the momentum portfolio, is there something systematically funny going on in the returns of the stocks that eventually end up becoming momentum stocks? Asset pricing. I think this is a kind of an obvious low-hanging fruit. Do expected returns depend on variance components, and which variance components? And there's sort of two levels at which one can look at this. The variance levels. So the model spits out estimates for the size of each of the variance components. The paper focuses mainly on the shares, which is just each component divided by the total variance, so they sum up to 100, but is there differences in asset pricing implications of levels and variance shares? That would be kind of interesting. And then we have this low risk anomaly that low risk stocks seem to outperform high risk stocks, especially on a risk adjusted basis. which one of the four variance components is the culprit behind this result. I mean, one of them at least has to be. There might be also some interesting opposite effects, that some variance components are positively priced, some are negatively priced. That would be interesting to look into. And then have some event studies in mind, not in the sense of looking like day to day, because you need sufficient amount of data to estimate the model. So the paper looks at 12 months estimation windows. I would like to know, can you do it with 6 or 3? So maybe a bit of guidance for people who might want to use these models. Can I just plug in 3 months of data and still get in a large sample sufficiently decent results? So what happens after index inclusions? Or what happens before index inclusion? There's the variance composition change once a firm becomes an S&P 500 stock. What happens around the Russell index cutoff? So there one could actually say something pretty accurate about the effects of indexing on this variance composition. The paper has something, some mentions of indexing going up, so this might affect some of the time series results, but you could look at around the Russell cutoff and be much more specific about that. What happens to the information shares before and after big corporate events like M&A? Is there a lot of private information floating around before M&As? What drives returns of newly listed stocks? Are newly listed IPO stocks, are they different from similar size and book to market firms? So I think definitely none of these things belong in the paper as it is. The paper is already thick enough. It makes a methodological contribution, but I think some of these might be interesting avenues for future research. And then I'm going to nag a bit. So I have these are both small points, but one of them is slightly less small than the second one. So I'm going to focus a bit on the signed trading volume, and then one point about the robustness of the VAR. So the paper estimates a structural VAR where the 3 variables are the market return, the signed trading volume X, and the return of the stock R. And we can see that the structure of the model is such that the contemporaneous same-day market return affects the volume, and same-day market return affects the return of the stock, and the same-day volume affects the return of the stock. So that's fine. The trading volume is measured, this X is measured as the product of the volume traded in terms of shares times the price on that day, so dollar volume times the sign of the return on that day. So that it's a positive number when the price goes up, negative number when the price goes down. Makes perfect sense, and this is not the first paper to use this kind of sign trading volume. But now that when we throw it in a VAR where the return on day T depends on the signed volume on day T, we have the same guy. So we have the sign of RT affecting XT and XT affecting RT. So RT is sort of on both sides of this equation. And this is more a question than an answer. Does having RT, or at least the sign of RT on both sides of the equation in this VAR, does it create any problems? This dependence, if you wish, of returns on the signed trading volume is what's driving, by the end of the day, after all those rotations and moving average representations of the VAR, it's driving the role of the private firm specific information. So is there a risk that we might be overestimating the role of private information share because the sign of RT is on both sides of this equation? I'd like this to be answered in the paper so that I could rest assured. I had to take a bit of data and see how this actually works. So it just shows Apple from last year, downloaded daily data, and run a model where Apple's returns, so this is not a VAR as they do, this is just a simple OLS regression of Apple's returns on the market on that day and XT on that day constructed as they do. The coefficient of XT gets a t-stat of 14.7. So there's a massive impact of the trading volume on that day to the return on that day. That makes sense, of course. But then the question is, how much of that is driven by the fact that the sign of the day's return is already there in X? So I do a simple bootstrap where I calculate XT by bootstrapping share volume. So I have this new variable that I call XT star, which is price on day T times sign of day T return, but then the volume is not for day T, but rather that is just some reshuffled numbers. I reshuffle the trading volumes and assign a random day's volume for day T. And then I run regression of the same regression I already had. So return on day T on market return times this bootstrapped XT and do that 10,000 times. And here's the distribution of my T statistics. So data gave us 14.7. It's over here on the right. The bootstraps or the simulations give this distribution, so centered around 8.5. So definitely in the data there is some of this trading volume on that day affecting returns, because this I cannot reproduce this 14.7 in the bootstraps. But the bootstrap sample is not focused around 0, centered around 0. I mean, we have very, very significant relation between return on day T and totally bogusly constructed XT that should not have any impact on the return on that day. So if I was just using this to sort of reject my hypothesis, I could not reject, or I could reject this zero hypothesis that there is no impact of the volume, but I'm a bit worried that my randomly generated data gets me t-stats of about 9. Might this lead to overestimating the private info share? Maybe the only slightly counterintuitive result, and this might be just me not understanding things, but in the paper, the only thing I find counterintuitive is that big firms have higher private information share. So this is table 2 or 3. I've cut it in a couple of places to just get those numbers that I wanted. So here we see Q1 is small firms, Q4 is large firms. The private information share, small firm variance is 21% private info, large firms is 30% private info. So that kind of goes against my intuition maybe. And so large part of the effect across size is that large firms have much more market info, small firms have much more noise, but I'm just adding a column here where I look at private info share percentage of total firm specific information. So these two, 21.6 and 37.79 for small firms, make up the total amount of firm specific information. I divide the 21.6, the private info, by the sum of these two guys. So this 36.37% in my new column is giving me how much of the total firm specific info is private. And even that is increasing in firm size. So larger firms have more private information. Could this be affected by the construction of XT? And the potential culprit here would be the shape of the trading volume distribution. So I do a simple simulation where I simulate totally random returns. So these returns they're not Apple or anything else. They're just coming from a normal distribution with 0 mean and some variance. And then I simulate the trading volume from a chi-squared distribution with different degrees of freedom and just regress return on X. And X is constructed like in the paper as the share volume times the sign of the return. I'm dropping price now. I'm assuming price is always 1, just to keep things super simple. And then what I do is I vary the degrees of freedom of my chi-squared distribution to get different kinds of trading volume distributions. And I sort of found this quite interesting. So when I put in a very high degree of freedom, so this on the right end of my graph, trading volume is less skewed. It's not very skewed. In such a case, XT explains a larger part of RT. So so I'm plotting here R squared, average R squared as a function of degrees of freedom. When I have large degrees of freedom, the XT explains a large part of RT. When I put a very small degree of freedom, then of course my trading volume is going to be super skewed, and XT ends up explaining a much smaller part of RT. So could it be, and I don't know, I'm just reaching here. Could it be that big firms, VT has a distribution that looks like a chi-square distribution with a large number of degrees of freedom, and small firms have volume distributions that look like chi-square with a small degree of freedom? So every now and then small firms have really massive amount of trading, but a lot of days it's really small. That's not terribly far-fetched. So could it be that the fact that VT is constructed, XT is constructed like this, and VT is different across the size spectrum, actually drives some of the conclusion we had earlier that large firms have larger private info share? I don't know. Then, as a kind of mandatory thing for every VAR paper, how sensitive are the results to changes in the VAR specification? I don't think they are, but it would be nice to see like different lag lengths, different structure, maybe not have XT explain RT, but remove that part would answer my previous question as well, and maybe some other tweaks. With that, I'm done. Overall, I think it's a fantastic paper. I'm looking forward to seeing it published, and I'm hoping people will take up all kinds of new cool research ideas using their method. Thank you so much.
All right, thank you, Petri. So you were definitely downplaying what you had to say before you said it. Thanks a lot. And so, Eliza, would you like to briefly respond?
Absolutely. First up, thank you so much, Petri. It was a great discussion, and thank you for taking the time to read it so carefully. And you've really picked up some excellent points. So in particular, the concern about our proxy for the trading activity, yes, we can't agree with you more. And what I alluded to in the presentation was that we've also used an alternative proxy, which is order flow, which overcomes the need to use the sign of the return from the day. So we've done some initial decompositions with order flow, and you're absolutely right. The private information share does change as a result of that. So there's more going into the public information share as opposed to the private information share when we substitute the trading activity. So that's a great point. The only thing is the order flow is not available for the entire sample period. It's only available for a sub period. So we're trying to get as close an alignment as we can with an overlapping period to fine-tune that decomposition. But I like your suggestion about taking it out of the VAR, so to minimize that. I think that's a great idea, and we can certainly tweak the VAR in that way. With the lag length structure, again, a great point. We use the 5 days because we can interpret that as a full trading week. But we've now also done the test for optimal lag length. And we've redone the decomposition, and we see there's not too much sensitivity to that lag length structure that we assume. But it's a great point. You've given us a lot to think about, so thank you very much. I like the suggestions to look at the anomalies to see if we can use this framework to understand the anomalies a bit more in asset pricing. I think that's a great avenue to pursue. So yeah, so you've suggested a lot of extra work for us, and we're very grateful, Petri.